Tyler, what you got for us here today on Jedi Options?
Yeah, thanks, Tim. The title of today's Jedi Options segment is Banks and the Poor Boy. I was thinking about banks when I got back from vacation, and it's one of the sectors that looks the strongest right now. And it's one of the sectors that has been benefiting from what's going on with interest rates. So I want to do a little introduction to how banks make money, why what's going on in interest rates is a tailwind or supporting banks right now, and then how do I make money off of it, specifically using a poor boys covered call strategy. We'll see if I can get to all that here in my segment. So let's go. I'm going to start with a picture here. If actually, I'll show you how to find this stuff. Okay, I'll teach you how to fish. One of the things that comes into play with this explanation on banks is the yield curve. If you just go to Google and you Google U.S. Treasury yield curve, you will get directed right to the Treasury Department's website, treasury.gov, daily Treasury yield curve rates. And you can see the history of the last month or so. But at the bottom, that's today, October, actually that's yesterday. So they don't post it till the end of the day, but it's close enough. It doesn't move that much day to day. What this allows you to see is the different interest rates on U.S. Treasury debt that matures at varying maturities or varying dates. And you can see that the 1 month T-bill, 2 month T-bill, 3 month T-bill, 6 month, 1 year, these are all like zero. Okay, so short-term interest rates are effectively zero. And that has to do with Federal Reserve policy and what we know as ZIRP or zero interest rate policy. Short-term rates have been zero for a long time. That hasn't changed. What has changed a bit as inflation has reared its ugly head this year, as economic growth projections have come back after the pandemic, is longer-term interest rates have gone up. And so where you see that is as you look out to like a 10-year, and I say go up, like are they high? They're not high relative to historical norms, but they are higher than what they were, say, last year at the same time or 18 months ago. So like the 10-year yield is trading for 1.65, and that is a fair bit higher than what it was 18 months ago. So these longer term interest rates have crept higher. And that also may not seem very high because 1.65% is not that high, but relative to other countries, the US does have a higher long-term interest rate. So when you plot this over time, essentially you could look at, say this is 1 year here, this is maybe 10 years, this is 30 years. So the horizontal axis is time, and then the vertical axis would be the interest rate, right? The interest rate. And so essentially, if you take each one of these interest rates and you plot them on the curve, or you plot them on this table or chart, you can then connect the dots and have a curve. So anything close to today, right? So this would be like today would be around zero, right? So short-term stuff is around zero. And then it doesn't really lift off till like after 1 year, because that's when the Fed is expected to start lifting rates. And then you'll see it goes up, gradually over time, right? So this is kind of the yield curve. Now it's compressed a little bit because the way I drew it, it makes it look like it's going up a lot, but just keep in mind the scale on the left here. So what about banks? What does this have to do with banks? Well, banks make money in large part because they borrow money from you and me, and they lend it out to people for mortgages and auto loans, and business loans. So essentially, when they borrow money from you and I, they pay us a little bit of interest. So what we do is we say they borrow at short-term rates. So borrow short-term. Because when you put money in a bank, they pay you a little bit of interest in your savings account. Now, these days, that interest is effectively zero. So they're essentially borrowing money from you and me for free. And then they lend it at longer term rates. And so when they create a loan, typically it's not a 1 month loan. Typically it's a 5-year loan or a 30-year loan. And the profit they get from that is linked to the interest rate that they charge. And so when you see a large discrepancy between short-term rates and long-term rates, the difference between the two is straight towards the bottom line of the bank. Okay, and that's known as net interest margin, net interest margin. And it's one of the main ways that banks make money. And so what we have here is a situation where short-term rates have not gone up, again, in large part because the boot of JPAL, this is his boot. He has his boot on short-term rates, okay? Short-term rates are effectively zero until they decide to lift them, but long-term rates have started to rise. And so as short-term rates have stayed low and long-term rates have risen, the spread between the two has widened, and that goes to the bottom line or the revenue or profits of these banks. So good for banks. It's good for banks. Now, if you want to see this, TNX is the 10-year yield. And if you look at this, say a couple of years ago, this during the pandemic was basically 0.4%. Okay, now it's 1.65% almost. And so 1.65 doesn't seem like a lot, but relative to where we were last year, it's a significant rise. And that in large part is why banks are doing so well right now, right? So rising long-term rates are doing well. And so if you were to be a trader of bank stocks, you'd probably want to keep track of that 10-year yield chart. You'll find there's a very strong correlation between the two. As yields go up, generally banks go up as well. And certainly we've seen that this year. So if I want to profit from that, if I think the economy continues to recover, if I think that interest rates, specifically longer term rates, will continue to be somewhat neutral to bullish, then one way to capitalize is to do a bullish trade on banks. Now, there's a variety of different ways you can do bullish trades on banks. You can buy the bank ETF, or more specifically the financial sector ETF. XLF is a $40 little ETF here. It's up about 4 or 5 days. Obviously would have been nice to have already been in the short run here, a little bit extended, but I still like trades on XLF. What I'm interested in illustrating today, however, is a specific option strategy near and dear to the heart of cash flow traders, known as the poor boys covered call. It is an alternative to a traditional covered call. And we actually have a list over at Tackle Trading. We have a list of stocks that we think are particularly good candidates for a poor boys covered call. It is part of our Tackle 25 system, where we've compiled lists each year that we update that are good for dividends, that are good for traditional covered calls, that are good for poor boys covered calls. And the ones that tend to be in the poor boys covered call watch list are expensive stocks that might be cost prohibitive for those trying to buy 100 shares, such as Goldman Sachs. Goldman Sachs is a investment bank, a very good one, make a lot of money. Look at their earnings per share here: $15, $18, $12, $15. Go find another company that has dollar figures that big from an EPS perspective. There's not very many. Now, $400 stock. I want to be bullish on banks for the next few months, maybe even longer, but I want a cash flow type of play that's similar to a covered call, but won't require me to put up 4,100 or what would that be? 41,000, 100 shares of this is $41,000, outside of the price range for most retail traders, I would say. And so what I'm going to do instead is I'm going to build a poor boys covered call. Now, if you want to know if you've done this proper, if you've built the trade right, what I would do is I would build a regular covered call first, and then I would compare, contrast the risk graph of the regular covered call to the poor boy covered call. And if they look somewhat similar, then I did a good job of creating a substitute strategy. If they don't look anything alike, then you probably didn't structure the poor boys covered call very well. So with a traditional covered call, it's a good time to talk about this because we're 30 days from the front month, November options. If I were doing a traditional covered call, I would typically buy the stock and sell like a 30 to 40 delta call option. I'm going to split the difference and go with this 36 delta. Actually, no, I'm going to go with the 30 delta, the 29.5 or 30 strike, not 30 strike, 30 delta, 425 strike. I'm going to right click and go to buy covered stock. Okay, and covered stock is thinkorswim lingo for covered call. And if I right click and analyze that, it's going to bring up a risk graph that looks identical to a covered call. And so essentially with this, I want the stock to get up to 425 and I could make almost $2,000, which is about a 5% return. Not bad, but I got to put up 40 grand to do this outside of really the price range I want to do here. So instead, even though I love the risk graph and it matches my mildly bullish outlook on Goldman Sachs, I want it to be cheaper. So with the poor boys covered call, the easy part is you still sell the same call option. I sold the November 425 for the traditional covered call. I would sell that for the poor boys covered call. So we'll start there. The difference is you're not going to buy the stock. It's too expensive. So in lieu of buying the stock, I'm going to buy a longer term call option that hopefully behaves like the stock, that is a good proxy for the stock. If you buy 100 shares of stock, you have a 100 delta. If instead you were to buy a 100 delta call, which is like deep in the money, that would be a perfect proxy for the stock. In other words, deep in the money calls behave like long stock. The problem is to get 100 delta requires you to pay a lot. So it turns out you don't have to go that far in the money to get a call that's good enough or that behaves close enough to long stock to be a good proxy. Turns out you could buy a call option that maybe has an 80 delta or a 70 delta. And you choose how high you want the delta to be, but just know the closer to 100, the more it's going to behave like stock. You can really use the risk graph to know if you're close enough. Because Goldman is quite expensive, I don't want to buy an 80 delta call. It's going to be pretty expensive. I want to buy maybe something more like a 60 delta, maybe even a 65 delta, and I think it'll work out okay. Now, I've got to buy at least December because I'm selling November against it. You know, long term is longer than November if November is short term. So if I'm selling November, I got to buy at least December, January, March, et cetera, et cetera. I personally don't like to go way out in time because it costs more and my return on investment isn't as good. So I'm actually going to amp up the leverage a little bit, maybe just do a 1 month trade here and buy December, sell November against it, and then maybe be done in November. So it'll be a 1 month trade here. So looking at my December options, if I go to maybe a 60 delta, it's going to cost me 2 grand. Well, 2,000 is better than 40,000. I've cut the cost by like 95% here. Could you buy a 65 delta? Sure. Could you buy a 70 delta? Sure. But you're paying $400, $700 more. If I can make it work with a 60 delta and get a nice risk graph, I think I'm going to be okay. So this is the one I want to buy. I want to buy the December 400 call as a substitute for the stock. So control click, buy the call, net debit, net cost going to be about $15.90. Way cheaper than the traditional covered call. Is it good? Is it an okay structure? I don't know until I look at the risk graph. Of all the strategies we teach, many of them you can get by without a risk graph. I would argue that when you start doing calendar spreads or diagonal spreads, which is what this is, that you need a risk graph. So I'm going to analyze this and look at it on the chart. Now, for me, when I look at this risk graph, it looks awfully similar to a covered call. And I can toggle back and forth. I can say, well, here was the covered call. Okay, so kind of a 45-degree line here, capped at 425, can't make any more money. Poor boy, diagonal line, capped at 425, can't make any more money. Looks pretty similar. I don't think there's any reason for me to fiddle with this structure. I think it's fine. Now, how much money can I make? At 425, I can make, looking at the blue number here, around 1,100 bucks. Call it 1,100. Well, making $1,100 on 1590 is ridiculous. Okay, 1,100 on 1590, it's like a 70% return. The covered call was giving me a 5% return. Okay, this is giving me more like a 70% potential return. Now, the ROI is pretty juicy because of the way I structured this. I bought a cheaper call, 60 delta instead of 80 delta. I bought December instead of buying March of next year. So I purposely made it a little bit cheaper to juice up the ROI here. I would have been satisfied with half this much. But I think it's a well-structured play. It gets me neutral to mildly bullish. And if Goldman can work its way towards 425, mean, come on, that's well within reason. In fact, I'm only 1.5 ATRs away from that. Goldman moves 1.5 ATRs in the next 30 days. I could potentially make upwards of 60, 70% return. That's pretty good for me. And that is a poor boy cover call on Goldman Sachs. 30-second summary. Banks have been very bullish this year. You can think the same thing that everybody thinks, which is the economy reopening, but also that rising longer term interest rates, which is expanding their net interest margin. That works to their benefit. I like Goldman Sachs as one of the ways of playing banks. Poor boys cover call, I think, is a good match for that stock. All right, end of lesson. There you go.